You've probably seen the headlines: $750 car payments, interest rates through the roof, and buyers drowning in debt. But what if I told you this isn't just a fluke? This is a warning sign, a signal that the auto loan bubble is nearing its breaking point. In today's video, we're peeling back the hood on a financial crisis that's quietly gaining momentum in driveways and dealer lots across America. What's fueling it? Who's at risk? And why your next car loan could drag you straight into a debt trap. Stick around, because this is about to get real. Let's start with the cold, hard numbers. A few years ago, a $750 monthly car payment would have raised eyebrows. Today, it's becoming disturbingly common. In fact, according to data from Cox Automotive and Edmunds, nearly 1 in 6 Americans who financed a new vehicle in the last year are paying $1,000 or more per month. For used cars, it's not much better. The average monthly payment now hovers between $550 and $750, depending on credit score and loan term. Why? The simple answer: car prices have exploded. New vehicle prices have surged past $48,000 on average, and even used vehicles are commanding near-record prices due to supply chain issues, inflation, and corporate pricing strategies. But it's not just the sticker price. Interest rates are hammering borrowers too. With the Federal Reserve raising rates to fight inflation, car loan APRs have jumped from under 4% in 2021 to 7 to 10% or higher in 2025 for many buyers. Combine that with extended loan terms, some stretching out 84 months or more, and suddenly, that affordable monthly payment turns into a long-term financial anchor. Add insurance, fuel, and maintenance, and many consumers are spending $1,200 to $1,500 per month just to drive. We are reaching a point where people are treating car payments like a second mortgage, and that's a major red flag. So what exactly is an auto loan bubble? Think of it like a balloon being filled with more and more air. Eventually, it pops. In this case, the air is made up of aggressive lending, skyrocketing prices, and unsustainable consumer debt. Total auto loan debt in the US has surged past $1.6 trillion, with a growing percentage of that debt considered subprime, meaning it's held by borrowers with poor credit. Banks, credit unions, and even fintech lenders are extending massive loans to consumers based on inflated car values, expecting them to repay over 6 or 7 years. But here's the kicker: many of these vehicles will depreciate faster than the loans are paid down, leaving buyers underwater. Sound familiar? It should. This is eerily similar to the 2008 housing crisis, where lenders approved massive mortgages without proper safeguards. The same logic is now being applied to cars. Approve now, worry later. But unlike homes, cars are depreciating assets. By the time someone is halfway through their 84-month loan, the vehicle might be worth 30–40% less than what they still owe. That creates a toxic feedback loop. People can't sell, they can't refinance, and they can't afford to default without wrecking their credit. It's a precarious balance, and it's already starting to tip. Let's not pretend this is happening in a vacuum. There are multiple players driving this dangerous trend, and yes, many of them are doing it knowingly. First, automakers and dealers are under intense pressure to keep vehicles moving off the lot. Inventory is up, demand is down, and the only way to hit quarterly targets is to lure people in with flashy offers. Low monthly payments, 0 down, no payments for 90 days. Sound familiar? These are all tactics designed to distract from the total cost of the loan. The longer the term and the higher the interest, the worse the deal becomes for the buyer. But it looks affordable in the short term. Then there's the financial industry. Lenders are increasingly using AI and big data to approve loans in seconds, often to borrowers with questionable creditworthiness. Subprime lending is back in full force, but this time it's wrapped in digital packaging. Fintech platforms promise convenience, but often come with higher APRs and looser underwriting standards. And let's not forget the consumers themselves. Many Americans are stuck in a cycle of car dependency, where lack of public transportation, long commutes, and cultural pressure make owning a car feel non-negotiable. No matter the cost, it's not always about reckless spending. It's about survival. But when survival requires a $50,000 vehicle financed over 7 years, something is clearly broken. The consequences of this bubble aren't limited to car owners. This debt is becoming a major drag on the economy as a whole. When households spend upwards of 20%–30% of their monthly income on a car, they have less left over for everything else. Groceries, savings, healthcare, rent, even childcare. Consumer spending is what drives the US economy, and when that spending shifts toward debt servicing rather than discretionary spending, growth slows. It also increases financial fragility. More people are one job loss or medical bill away from default. And defaults are already rising. According to TransUnion, auto loan delinquencies have hit their highest rate in over a decade, especially among subprime borrowers. That means more repossessions, more financial stress, and more downward pressure on used vehicle prices. As those prices drop, lenders will get stuck with depreciated assets, triggering potential losses in the billions. It's a classic bubble scenario, first inflated by easy credit and irrational pricing, then brought down by reality and recessionary forces. If the bubble bursts hard enough, it could even spill over into the banking sector and trigger a credit crunch similar to 2008. But this time, the epicenter would be the auto market. So, what does the road ahead look like? If interest rates stay high and the economy slows, defaults will likely accelerate, and both automakers and lenders could face a reckoning. Some are already bracing for impact. Car repossession firms report a massive uptick in activity, and used vehicle prices are beginning to drop, which could trigger a wave of negative equity. If this continues, we may see massive dealership closures, loan write-offs, and even bailouts for automotive finance arms. But it's not all doom and gloom. You still have power. Whether you're in the market for a car or already locked into a loan, now is the time to reassess your finances. Don't get lured by monthly payment marketing. Look at the total loan cost, factor in insurance, and avoid long-term loans whenever possible. Consider buying used, even if it means driving something less flashy. And most importantly, don't let the fear of missing out push you into a decision that could haunt you financially for years. The $750 car payment isn't just a number, it's a warning. A signal that the system is straining and something's got to give. The auto loan bubble is real, it's growing, and if we're not careful, it could take down more than just our bank accounts. So stay smart, stay skeptical, and spread the word. If you found this video helpful, hit that like button, subscribe for more deep dives, and drop a comment below. What's the highest car payment you've ever seen or paid? Let's talk about it. For years, car dealerships have leaned into one of the most deceptive sales tactics in finance: advertising the monthly payment, not the total cost. And for many buyers, that's the number that sticks. $499 a month, I can swing that. But buried in the fine print is a disturbing reality that affordable payment often comes with 72-84-month loan terms, ballooned interest rates, and thousands in hidden fees or add-ons. Buyers walk away, thinking they got a great deal, not realizing they'll pay $10,000 to $15,000 more over the life of the loan than the car is actually worth. This model thrives on consumer financial illiteracy, and frankly, it's by design. Dealerships are trained to upsell protection plans, gap insurance, window etching, and more, all of which get rolled into your loan and disguised by that sweet-looking monthly figure. And when you stretch that over 7 years, a $35,000 car quickly becomes a $50,000 obligation. It's financial sleight of hand, and many consumers don't realize the trap until it's too late. One of the most dangerous outcomes of long-term high-interest loans is negative equity. This happens when you owe more on your car than it's worth, a situation that millions of Americans now find themselves in. It turns your vehicle into a loan prison. You can't sell it without bringing thousands in cash to the table. You can't trade it in unless you roll that negative equity into another loan, which just compounds the problem. It creates a vicious cycle, especially for buyers who habitually trade in vehicles every 2 to 3 years. Lenders and dealers are more than happy to trap consumers in this revolving door because every trade-in with negative equity becomes another opportunity to stack fees, stretch terms, and lock customers into yet another overpriced loan. Over time, the buyer becomes less of a customer and more of a debt host, carrying around a depreciating asset they don't truly own, just to keep the wheels turning. The financial strain of these massive car loans isn't just felt in wallets. It takes a very real psychological toll when someone is paying $750 or more every month just to get to work, Knowing that missing even a single payment could trigger repossession, stress levels skyrocket. For working-class Americans already juggling rent, groceries, medical bills, and student loans, this added burden can become overwhelming. Studies have shown that financial stress is one of the leading causes of anxiety, depression, and relationship problems. And car debt is particularly toxic because it feels unavoidable. If you live in a car-dependent city or suburb with poor public transit, you literally can't function without a vehicle. It's not a luxury, it's a lifeline. But that lifeline has become so expensive that it's dragging people under. And as inflation eats into wages and layoffs mount in certain sectors, we're going to see more people defaulting. Not out of irresponsibility, but out of desperation. There's a whole industry profiting quietly behind the scenes of this crisis. Auto repossession. As delinquencies rise, repossessions are booming, up as much as 30 to 40% year over year in some markets. Repo agents are working overtime, often with high-tech tools like license plate readers and GPS trackers to locate and recover vehicles quickly. For many Americans, the moment they miss a payment, the countdown begins. Some don't even receive a warning. The car is simply gone one morning. And what happens next? The lender auctions the car off, often for less than what you still owe, and you're on the hook for the remaining balance, plus fees. It's not just a financial setback. It's a devastating personal blow. Imagine losing your job, then your car, then getting sued by the bank for a $10,000 deficiency judgment. This isn't a hypothetical. It's real life for thousands right now. And yet, the system grinds on, because for every car repoed, another loan is approved. Here's a question. Where are the regulators in all this? Why hasn't there been a crackdown on predatory lending in the auto industry? The answer lies in a combination of regulatory blind spots, lobbying pressure, and outdated consumer protection laws. Unlike the mortgage market, which came under heavy regulation after the 2008 crash, the auto loan market remains loosely regulated, especially when it comes to subprime lending. Car loans aren't subject to the same oversight as credit cards or student loans, and dealers enjoy certain exemptions from federal consumer lending laws. Meanwhile, powerful industry lobbies, like the National Automobile Dealers Association, spend millions every year to block reforms that would limit their profit margins. There have been efforts to improve transparency, require better loan disclosures, and ban certain dealer tactics. But progress is slow. In the meantime, consumers are left exposed to a wild west of financial engineering, and the federal government, so far, is just watching from the sidelines. There's another twist to this story: the EV revolution. As automakers push to transition to electric vehicles, the price tags are getting even steeper. EVs generally cost more upfront, and while long-term savings are real, many buyers can't afford to pay $55,000 or more for a new vehicle, even with government incentives. So what happens? The same lending traps get recycled. Longer terms, higher balances, bigger risks. What's worse, EV depreciation is still a big unknown, especially with rapidly advancing battery technology. A $60,000 EV today could be worth half that in just a few years if newer models make it obsolete. That introduces even more risk into an already fragile system. If people start defaulting on EV loans, it could drag down both auto finance and the green transition. It's ironic. The push for cleaner cars could be sabotaged by the same predatory lending practices that wrecked gas-powered car ownership in the first place. Finally, let's talk about the used car market, because this bubble isn't just about new vehicles. During the pandemic, used car prices skyrocketed due to supply shortages and manufacturing slowdowns. But now, as interest rates climb and demand cools, prices are falling fast. That's bad news for anyone who bought a used vehicle in the last 2 years. Many of these buyers are now upside down, holding loans that far exceed what their vehicles are worth on the open market. And it's not just individuals who are exposed. Used car dealerships, rental companies, and lenders who finance those deals are also facing major losses. Some industry analysts are calling this a controlled crash, a slow-motion collapse of the secondary market that could accelerate quickly if defaults surge and resale values plummet. If that happens, expect a flood of used inventory, fire sale pricing, and another wave of financial instability rippling through the economy. The American consumer is simply burned out. Years of inflation, stagnant wages, and skyrocketing costs across the board, from rent to healthcare to groceries, have left most households with little to no room for large discretionary purchases. Car prices surged during the pandemic due to supply chain disruptions and chip shortages. And while inventory has finally normalized, prices have not come down nearly enough. New vehicles routinely cost $45,000, $60,000. Even entry-level models are now flirting with luxury tier pricing. And with interest rates still elevated, financing a vehicle is cost-prohibitive for millions. Consumers are increasingly holding on to their cars longer, avoiding dealerships altogether, or turning to the used market if they can find anything remotely affordable. The traditional model of trade in every 3 to 4 years is dying fast. As monthly payments skyrocket, auto loan balances have ballooned to over $1.6 trillion, reaching crisis levels. Many buyers are now shelling out $700, $1,200 a month just to own a basic vehicle. Subprime borrowers, those with lower credit scores, are especially vulnerable, with default rates rising sharply. The situation is starting to look eerily similar to the 2008 housing bubble. Artificially extended loan terms, high-risk borrowers, inflated asset prices, and lenders who knew the risks but chased profits anyway. Now, the bubble is beginning to leak. Repossessions are climbing, defaults are rising, and banks are bracing for impact as more Americans simply walk away from vehicles they can no longer afford. The push toward electrification has been anything but smooth. While Tesla once dominated the EV space, the entire industry is now saturated with competition, from legacy automakers like Ford and GM to foreign players like BYD and Hyundai. Yet consumer demand for EVs in the US is cooling, not accelerating. High costs, limited charging infrastructure, and range anxiety are making buyers hesitant. Many EVs are sitting on dealer lots, unsold, despite government incentives and aggressive marketing. Meanwhile, automakers are investing billions into EV factories, batteries, and software development. The result? Massive financial overextension. If EV sales continue to underperform, automakers may be forced into layoffs, production cuts, and major strategic retreats, just as their internal combustion engine businesses are winding down. Dealerships, once the gatekeepers of car sales, are increasingly seen as outdated and problematic. Consumers don't trust them. Younger buyers prefer online transactions, and the dealership lobby's resistance to change is hurting the industry's evolution. The traditional franchise model is also clashing with the direct-to-consumer strategies of companies like Tesla and Rivian. As vehicle margins shrink and public sentiment sours, dealerships are relying more heavily on predatory lending tactics, hidden fees, and overpriced financing products to stay profitable. But this short-term thinking is eroding long-term trust and accelerating the breakdown of the entire retail model.